Hello, Finimizers. Welcome to another Finimize live event. My name is Stefan, your Finimize analyst, and I'm hosting today's event about the art of portfolio construction with our partner, CFA Institute. So before we start, let me just go quickly through some housekeeping rules. So feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. In terms of format, this is going to be a 15-minute conversation followed by 15-minute audience Q&A. So make sure to use the Q&A box to ask a question. And if you see a question you like, upvote it so it moves to the top. And that way, we can get through the most upvoted questions first. Hello from Toronto. Well, that's a good start. All right, let's kick this off. So our event partner for today is CFA Institute. They are the global associations of investment professionals that sets the standard for professional excellence and credentials. They are the champion of ethical behavior in investment markets and a respected source of knowledge in the global financial community. There are more than 190,000 CFA charter holders worldwide in 160 markets. I'm actually a CFA charter holder, and I would definitely recommend it to anyone who's considering a career in the industry. Also, don't forget, CFA Institute has crafted the Investment Foundation Certificate, which is the perfect course to help you learn the language of investing and accelerate your career in finance. We have a special deal available for you today, so we'll drop a link in the chat box right now to explain it a little bit more. And today I'm joined by Robert Stammers again. He's the founder of a financial communications company that creates investment content for institutional clients. Previously, he was director of investor engagement on the Future of Finance team at CFA Institute. And prior to that, Mr. Stammers was a senior executive for several institutional fund managers. So fair to say he knows what he's talking about, and we're very lucky to have him today with us. So how are you doing today, Bob?
Good. Thanks for having me back. I appreciate it.
Great. Okay, so let me start by asking you, let's say I'm a young professional today, and I want to build a long-term passive portfolio for, say the next 20 to 30 years. So, really, I have a long-term horizon in mind. What do I need to know before I start? What sort of questions do I need to ask myself before I build such a long-term portfolio?
Okay, so the first thing you have to do is what's called an investment policy statement. And if you've had any experience with robo-advisors or any kind of financial engines, these are the questions they usually ask in order to determine an investment strategy for you. Okay, so the first thing is, what are your goals? Right, goals are super important because you need to know what you're investing for. It's going to drive everything. It's going to drive the things that you invest in, the way that you invest in them, because you have to make sure that you are going to get enough return for you to reach your goals within your allocated time period, and that you're not taking overdue amounts of risk. So after goals, the next thing is lifestyle. Okay, what kind of lifestyle are you going to live, and how much is that going to cost you? And the reason that's important is because you need to understand how much money are you going to have available to invest. And as I think I mentioned before, that continually investing in the market has as much to do with achieving your goals as the return on the market. So you need to understand that back into how much can I invest. And so now, how much return do I need to get on that investment in order to reach my goals? The third one is, how much risk am I willing to take? Okay, because you want to build a portfolio that's going to achieve your goals, but it's not going to keep you up at night because you've taken so much risk. Okay, so you need to understand, what's my financial ability to take risk and what's my emotional ability to take risk. So, you might want to have 100% portfolio in equities, but the problem is the returns are so variable that you can't stay invested in it because emotionally you can't handle the ride. And so you really need to understand your risks and how is that going to affect the investments that you're going to invest in. So that should all drive an investment strategy. And so there's lots of different investment strategies. I think the ones most people have probably heard are growth and income, and maybe capital preservation. And it just means taking more and more risk. So a growth portfolio, you want high returns, higher risk. Income portfolio is probably dominated more by bonds. So it's less return, less risk. capital preservation would be very little risk because you don't want to lose any of your capital. And then that'll drive what's called asset allocation. How much of your money are you going to put into each of the assets? So you need to understand the assets that you're going to invest into, right? So if I'm going to invest, you don't need to be, an expert, but you need to know the rudimentary influences on the assets that you buy, whether they're equities or bonds or alternatives, because when the market changes, you want to have a sense of what that may do to your portfolio.
So what sort of asset classes should I include in that long-term portfolio? And maybe you can just link it back to, this kind of return objectives and risk tolerance that you mentioned at the beginning. Just
Sure. So, the model portfolio that's always kicked around is something called the 60-40 portfolio, which is 60% equities and 40% bonds, right? That's kind of a little bit of growth because it's higher weighted to equities. So equities and bonds are kind of the traditional assets that everyone invests in. And, there's no reason to believe that that'll change much in the future. Although the traditional path has been those two, and now we're seeing investors invest in more alternative assets. I'll get into that in a second. So, equities are ownership shares in companies. You're basically getting high returns, but high variability, high volatility, simply because that's the way the market moves. The market does what's called a random walk, right? And so values are constantly moving, and they move more than most other assets, right? So, if you want to do a higher growth portfolio, then you'd invest more in equities and less in bonds. On the flip side, bonds are basically the debt of a company, which provides less return, but also much less variability in returns because it has a stated interest rate. And so the only thing that's really changing the values of debt are interest rates themselves, right? So as interest rates go up, the values of bonds go down, and conversely, when interest rates drop, the value of those bonds go up. And so right now, I looked at, and each asset management firm and each investment firm will have different ideas of what their estimates are for the future, right? But I think I looked at the Vanguard ones, and equities are expected to do about 10% over, just general equities, 10% over the next 2 years, from anywhere between, I don't know, let's say -3 and 17%. So even though you're going to get 10% over the 10 years, you're not going to get 10% every year. It's going to be somewhere between -3 and 17 for that 10 years. Bonds, on the other hand, are somewhere around 4%, and somewhere between -2 and 10%, right? Now, obviously, when you put those together, you get some diversification, and so you get a better risk-adjusted return than that. The next set of assets are what are called alternatives, and they really capture a whole bunch of different types of assets, like hedge funds, commodities, private debt and equity, real estate, just to name a few. And those are all in the alternative space because they're not those traditional building blocks of equities or debt. And people take higher allocations or to those assets to fill a role in their portfolio. Okay, some might be. We talked about core and satellite approach, where you have your core portfolio and then you take some additional risk in your satellite. Alternatives might be that satellite, or hedge funds, or real estate might take that role. Or depending on what's happening in the macro environment, you may add or subtract something from your portfolio to adjust. So we've been in an inflationary environment, so you see a lot of people investing in real estate and or commodities because they're very good inflation hedges. So yeah, those are the basic ones. And if anyone has any questions of any specific ones, I'm happy to take.
So now, yeah, I think we will probably go back to that question, I think, in the Q&A later. And I think some people will probably have questions on other asset classes as well. But before we move to that Q&A, first let's just talk about diversification. So, when you're building such a long-term portfolio, what's the right level of diversification? Is there such a thing as too much or too little diversification?
Sure. So there's a thing called market risk, right? And market risk which is denoted by the Greek letter beta in financial circles. It's the amount of risk that you take from being invested in the market. So as an investor, you don't get paid for taking anything but market risk because you can diversify down to the market risk, right? By adding more assets to your portfolio, you can finally get to market risk, and that's what you're getting paid for. And you're not taking what's called unsystematic risk, which is risk that's not diversified because you don't get paid for it. So going back to your question, can you over diversify? Yes. The benefits to diversification is the reduction in risk. The downside is it also reduces return. Now, the return is a better risk-adjusted return, means you're getting paid more for the risk that you're taking, but it also reduces return. So number one, you could diversify to a point where you're not getting enough return to reach your investment goals. And so why build a portfolio that's not going to get you there? Yeah, I mean, you could diversify down to very little in terms of return, but it's not going to get you to where you want to go. The other thing is, if you've already diversified down to market risk, diversifying any more can lead to other problems. Let me give you an example. So let's say you're invested in the S&P 500, which is a large cap index, which means that most of the companies in the index are large companies. And then you say, well, I want to diversify more, so I'm going to buy a large cap fund. Well, a lot of those assets are going to be the same companies, right? So you haven't really added to diversification, but what you've added to is maybe an additional exposure to some industries that you didn't want to take additional exposure to, because now you're invested in both those places. And so that ends up actually providing more risk to specific companies, usually more in transaction costs because you're buying more assets, and then there's advisory costs and other things for having these other assets in your portfolio. So you really want to try to get to diversify down to market risk, and then really think about, if I'm adding something to this portfolio, what's the role that it's doing in my portfolio, and is it really adding to more diversification or not?
Thanks a lot. I think we have just time for one last question before we move on to the Q&A. And I think, I'd like to ask you about what you think should be the role of active investing. So, here we mostly talked about how to build, I would say, a passive portfolio, talking about the long-term objective, risk tolerance, diversification, all of these kind of things. But, I think a lot of our users, they've got either specific views on a specific stock or a specific sector or a specific, cryptocurrency, or, sometimes they've also got specific views on what the economy is most likely to do over the next few months, etc. How much sort of active investing would you say is good, or perhaps, what is too dangerous? What should be the kind of mix between passive and active investing for a long-term portfolio?
Well, I think actually, in my opinion, it's more about the sophistication of the investor themselves. Because what you're doing in active investing is you're trying to time the market, or you're trying to look for inefficiencies in the market and change your allocations or change your strategy accordingly to get additional return for a short period of time, usually for a shorter period of time. Okay. And so that requires investors to have a really good sense of the market. They have to have either they can use someone else's or they have to have their own analysis of the market and where it's going. But then you also have to have a sense of how those market changes going to change the assets I'm invested in, right? And so there's a lot of work and a lot of time and a lot of sophistication around that, because you need to be able to change. You have to be nimble and change relatively quickly your allocations or your investments to correspond with the changes in the macro environment. And that's difficult for most retail investors, right? I mean, most retail investors are passive investors. They invest in ETFs or mutual funds, or if they are active investors, they're usually buying active funds where the managers themselves are doing the active investing, making the monetary decisions. But as an investor, if you want to be the person making those decisions and changing your allocations, you really have to have a good set out idea about first, what's going to happen to the marketplace and what's the influence it's going to be so that you can make the correct allocation changes. So going back to your question, I think it can be done. I think it makes sense if you can find the right opportunities. I mean, that's what hedge funds are all about. That's what they do, right? They're constantly looking for inefficiencies in the marketplace and investing in those things that can provide a over market return. They can beat the market, so to speak, which is a very hard thing for most investors to do. But it takes that kind of sophistication and time in order to be able to pull it off correctly.
Thanks, great answer. Okay, so now let's move on to the Q&A. So please, everyone, if you have a question, make sure to type it in the Q&A box, not in the chat box, and then make sure to vote for the questions that you would like to see answered first. So here, the first question is, what about ETFs? Are they a good inflation hedge? Would it be a good idea to solely rely on investment?
Well, an ETF is just a structure, right? It's just an exchange traded fund. So you can have ETFs in equities, ETFs in bonds. You can have actively managed ETFs. So ETFs themselves aren't necessarily an inflation hedge, right? So an investment in a commodities ETF or a REIT ETF might be an inflation hedge. And the reason I say that is commodities do very well in inflationary environments because the prices simply get passed on to the consumer and they're relatively inelastic. Real estate, I think I mentioned before, a lot of real estate owners can pass the higher prices on to tenants, so their income doesn't change, so they tend to perform well in inflationary environments. So those ETFs might be something to look into. So really thinking about what performs well in an inflationary market, and then look for those ETFs and invest appropriately to provide some hedge on your portfolio.
Okay, the next question, what is the best platform to use as a basis for your investment portfolio, preferably in Europe? And here, maybe you cannot give like specific recommendations, but just talking, broadly of what are the options, basically.
So I don't know if I understand the question in terms of platform.
What is the best platform to use as a basis for your investment portfolio? So I think here is, I don't know if this is a specific broker, which obviously you can probably not reply.
Yeah, if that's the question, I mean, that's a personal choice on who you want to use. There's some very well-known broker dealers out there with lots of different trading platforms that may work out for you. So if that's the question, I really can't provide too much specifics. If it's more about in Europe, what I would invest in, then you want to have a globally diversified portfolio. And investors tend to be very nationally focused. They tend to like to invest in the countries that they are in or in the areas that they are in because they understand it. For example, most US investors invest in US stocks, but it's really important on a diversification level to invest in different places. So if in Europe, you want to have, and I'm sure you would because of the market, but a good allocation to US stocks as well as Asian and other, and probably some emerging market equities as well, because they tend to outperform in certain times. So as a diversifier and as a return producer, it's good to have, investments all over.
Now, a great next question. Is there a single metric that's most useful to assess portfolio risk?
Yeah, it's called the Sharpe ratio. And basically the Sharpe ratio is the return that you're getting over the amount of risk that you're taking. And you can look up the calculations. I won't go into it now, but basically what it's telling you is how much return are you getting for each unit of risk that you're taking. And that gives you a way to compare funds or investments, because you can look at historically which of these have been given, been less variable for the returns that they're given. You can calculate that on your own portfolio and benchmark it against other similar types of portfolios to see if you're doing well or not. But that's probably the best way of determining your returns. Now, this risk in general is usually the variability of returns. So how much are your returns going up and down with the market? And I think I mentioned before about beta, which is that market risk. You can have a portfolio that is, too beta, and that means you're going to get twice the amount of variability in return as the overall market. So, you're looking at basically how much of the returns going up and down and how much you're getting paid for it.
Another very interesting question next. How do you integrate hype-like investment opportunities, AI, Web3, etc., into your portfolio? How long should one observe the hype curve? So I guess let's just focus on the first part of that question. How do you integrate those higher octane investments into your long-term portfolio?
Well, once again, I think it comes back to the sophistication argument that, it's a generality, because some people can't, because they just don't understand it, right? And don't have access. So, there's so many different engines out there that are doing just that. I think I mentioned something like, I think Vanguard uses something called Edelman Financial Engines, right? And it's basically a way of constructing a portfolio by giving them certain information. That's AI right there. So it really depends at what level that you want to use it, and if it makes sense for you. I don't know that I can give you much more than that.
Okay, another question. How do you differentiate a scam from a genuine investment? There are a lot of companies on social media claiming that they will make you money by telling you which stocks to invest.
Usually the rule of thumb is if it's too good to be true, it isn't. If the market, like I said before, equities are expected to give you, a 10% return. A globally diversified portfolio is probably something around 6 or 7 now for the next 10 years using those same assumptions. If you have someone saying, I can give you less risk, but a return larger than that, then it's probably a scam. It's a little bit of common sense, but you got to look at what the market's bearing. And if someone can say to you, we're going to offer you more than that without a compelling argument and facts and figures that support it, then it's most likely a scam.
Okay, next question from Marco. What long-term strategy do you suggest? What are your thoughts on dollar cost averaging?
Well, as I mentioned before, I think by continually to invest in your portfolio has a a lot to do with you achieving your portfolio. Because at the end of the day, investment management is about increasing the probability of you reaching your goals. So, yeah, so I lost my train of thought there for a second. Could you repeat the question for me?
It's your thoughts on dollar cost averaging, and you said.
Oh, yeah. So, yeah, sorry. Yeah, so you want to be constantly investing in the market, and that's dollar cost averaging, because you're buying when prices are high, but you're also buying when prices are low. You're constantly putting money in the market and getting a return for it. So it's a very, and unless you're going to be like a super active investor and really try to take advantage of short-term inefficiencies or changes in the macro environment, and you're going to be a long-term passive investor, it's much better. It's a really good idea to just continue to invest in the market. Like I said before, the market's going to return what the market's going to return. It's not going to do the same thing every year, but for the next, according to the estimates I said before, I think you invest in equities, you're expected about 10% over the long term. So whether you buy the assets when they're down or buy the assets when they're up, you're still expected to get somewhere around 10%. So it makes sense to just keep putting the money in the market. Like I said before, if you want to be more active in your portfolio and you want to, do what's some tactical or dynamic asset allocation where you're changing your allocations to the market, then it may make sense to reduce putting in more capital if you think the market's going to do poorly. But for most investors, I think continually investing in the market and dollar cost averaging makes a lot of sense.
Now, a question about bonds. How do you invest in bonds for the long term when interest rates are changing? How do you analyze whether interest rate changes over short to medium term would impact long-term assumptions around interest rates?
Well, like I said before, so, bond values are inversely correlated to interest rates. If interest rates go up, bonds go down. Interest rates go down, bonds go up. So if you think interest rates are going to rise, what most people do is they shorten the maturities of the bonds they invest in, because they won't be as sensitive to those changes in interest rates. The longer the maturity of the bonds, if you have a bond that's 1 year and a bond that's 30 years, the 1 year is going to have less sensitivities to changes in interest rates than the 30-year. So when interest rates are dropping, most people go out the yield curve, right? They tend to put a higher allocations to long-term bonds, and when interest rates are doing the other thing, they go short in order to be more defensive. And so once again, you just have to have a very good sense of what you think interest rates are going to do, and if you're going to change your portfolio, then you really need to understand how much are they going to change, and then invest accordingly.
Thanks a lot, Robert. So that's all we have time in terms of time for today, unfortunately. But thank you so much for joining us, Bob. Thank you everyone for joining as well. I hope this has been super useful and informative for all of you. Remember to fill out the feedback form that will pop up on your screens when this ends. And yeah, hopefully you all enjoyed today's event, and we're looking forward to seeing you at the next one. Bye, everyone. Bye, Rob.
Thanks, Stefan.